There is a very strong bullish case for uranium to be made, for those that have been paying attention. High-profile climate change activists have increasingly been advocating for nuclear power to be brought in the fight against the climate crisis, with Greta Thunberg arguing for Germany to reopen its shut-down reactors. After the Fukushima disaster, Japan too has been reopening its reactors, whereas India and China are both seriously increasing their nuclear resources for power production. All these tailwinds come as the uranium enrichment segment shifts from under to overfeeding in recent years. Analysts point out that there has been a clear lack of investment flowing into the uranium sectors for at least a decade, which has resulted in a structural supply deficit. The world is finally starting to open its eyes to this blaring opportunity, with investors identifying the sheer potential in this improving market. In light of this, we bring to you a list of the 5 best uranium stocks to buy and hold for long-term growth. To start off our list, we take a look at the American Colorado-based uranium developer, Uranium Energy Incorporated, which holds the trade ticker, URG. With its market capitalization of below $300 million, URG may seem like an insignificant player among the mighty titans of the uranium industry, but it has much to offer that makes it very compelling, especially from an investment standpoint. Firstly, the company is based in the United States, a country that reports some of the highest uranium consumption figures in the world, yet its domestic production of the material remains close to zero. It boasts lucrative uranium assets in the mining-friendly states of Wyoming. Therefore, it stands to become a critical supplier within its home market, at a time when uranium supply chains continue to face limitations, due to the political uncertainty in the countries where uranium is abundant. Its flagship project, Lost Creek, in the Athabasca region has been in operation for over a decade, and stands as being significantly economically viable, due to the ISR mining method. It is also looking to initiate construction of another major project site, the Shirley Basin, for which it has acquired all approvals. Above all, URG's balance sheet is extremely robust with cash holdings of $40 million, and a total debt figure of $12 million. Its uranium inventory amounts to 325,000 pounds. It has signed several supply contracts to key players through the current year and for 2024, including a sale of 600,000 pounds of uranium to the US Strategic Reserve. With all these strengths, URG is also extremely attractive due to a potential undervaluation. Its enterprise value of $243 million is below the net present value of its 2 primary projects, which total $251 million. URG has all the salient features of a uranium treasure pot for investors to tap into. The second stock on our list is Global Atomic Corporation, which trades in the OTC markets as GLATF. Although the company boasts a promising zinc mining project in Turkey, the real star of its show is its Darsa uranium site in Niger, within the African continent. Global Atomic holds an 80% stake in the project, with the remainder belonging to the government of Niger. It being a shareholding partner bodes extremely well for the company, as the government is incentivized to fast-track permits and licenses towards speedy commercialization. Moreover, the Darsa site is situated in a well-established region with access to both robust infrastructure and a skilled local labor force. Based on drilling data conducted, the uranium ores from the site hold a uranium grade of 0.53%, which is drastically higher than resources extracted from other sites in Africa by developers. From the get-go, this already delivers a drastic competitive edge to the company. Drilling data further suggests production levels of over 44 million pounds of uranium, extracted over a 12-year mining life. Even when considering a very conservative spot price of $35 per pound of uranium, the project stands as being extremely economically viable, with a 45% internal rate of return, and a net present value of $460 million. If uranium spot climbs to about $50 per pound, these figures could drastically surge up, and further enhance the overall value for Global Atomic. This uranium pick is a ticking time bomb, and is on the verge of a price explosion, as soon as uranium spot takes on a marginal climb. Before we move on to the next stock, we'd like you to know that we offer a morning newsletter to our email subscribers. Prior to the market opening, we send our subscribers an informative email about which stocks are moving, or about to move. You will get an overview of key earnings reports, recent insider transactions, analyst upgrades, and downgrades. To take advantage of this offer, you can find the link in the description box. If you're still with us, it means you've liked our video. Do click on the like button to show your support. Number 3 on our list is Uranium Energy Corporation, which trades by the ticker UEC. Uranium Energy is based in the United States, with premier sites in the mining-friendly states of both Wyoming and Texas. In addition, the company also has a presence in Canada and Paraguay. It has been pursuing a strategy to solidify its North American portfolio, as the US government looks to secure its energy supply structures, in the wake of growing geopolitical uncertainty. Although the company's Texas site has a total resource size of over 9 million pounds of uranium, the Wyoming asset is likely to deliver up to 66 million pounds, making it a strong going concern in the United States for the next few decades. Additionally, both these sites upon production will be using the SRI method of mining, which is both more economically feasible and delivers a much smaller environmental footprint. The management has been following a wait-and-watch strategy at present, looking to begin production when the uranium spot rises to new heights. It has a total cash holding of $32 million, and also stored uranium reserves of £5 million, which it can sell to raise further funds if the need arises. Following this consolidation approach, UEC has also been making major acquisition deals to strengthen its portfolio, by recently purchasing the Canadian player UEX Corp. The deal not only gives UEC access to the world-class, uranium-rich Athabasca Basin, but also delivers to it high-quality pre-production uranium resources. It is evident that there is hardly any pick better than UEC, that has been aligning itself better to a uranium surge. For those bullish on the uranium industry, this is clearly the stock to go for. Next up, we take a look at the Canadian exploration and development company, Denison Mines Corporation, which also goes by the ticker DNN. Denison Mines has a specific focus on the promising Athabasca Basin in Canada, with its Wheeler River project with probable reserves of 109 million pounds of uranium composite. The company is the very first to bring the low-cost ISR mining method into Athabasca, making it a pioneer with a major competitive advantage. According to a recent feasibility study, the site holds a recovery rate of 97%, which is drastically higher than the 85% rate determined in 2018. Another major milestone was the successful pH level study conducted on the leach site, falling within regulatory requirements. This is significant because environmental permits are typically a major obstacle within the Canadian jurisdiction. Apart from these strengths, DNN has an extremely robust balance sheet that is completely debt-free. In addition to its liquidity position of $150 million, it holds uranium reserves of over £2.5 million. The management is committed to a sustainable strategy of putting into production its low capex and high margin sites, and then using the cash flows to gravitate towards higher capex projects. All of these factors place Denison Mines at a core advantage, which could see it take off exponentially in the following years. The final stock on our list is the large uranium producer, Cameco Corporation, which holds the trade ticker CCJ. Cameco has been making big moves, as the world starts to ease up to the prospects of nuclear. The company recently restarted major projects, including Key Lake and McArthur River, after 4 years of shutdown. Its recent acquisition of Westinghouse Electric Company also takes Cameco out of the domain of being a pure-play uranium stock, but a fully integrated uranium conglomerate, which would stand well positioned to be a primary supplier for the uranium utility industry. Based on an already existing operation structure, CCJ has been performing remarkably over recent years, consistently outmatching consensus estimates for EPS. It expects top-line growth to continue above 20% for at least the next 2 years, even when assuming conservative uranium spot price estimates. Another factor of appeal is the relatively low risk associated with Cameco Corporation, due to the diligence of its management. Its contract portfolio is overwhelmingly diversified, with an average value of £23 million of uranium every year, for at least the next 5 years. Moreover, its projects are low-cost Tier 1 mines in Canada, which is an excellent site without supply risk by geopolitical tensions. CCJ therefore presents a remarkable opportunity that investors should not miss out on. That's all from us in this video. We hope the insight we aimed to deliver has proven valuable to you, and would allow you to ensure your portfolio is well suited for long-term growth. We would love to hear your feedback about our list in the comments below. To gain a deeper insight into different stocks that are fit for various investment strategies, be sure to check out our website, stockstelegraph.com.